Good afternoon, everyone, and welcome to today's webinar. I hope everyone is keeping well and enjoying the summer so far, providing you don't support the England football team. I am Paul Newsome, based here in Geneva, and I'm delighted to be joined by three of my colleagues from our global secondary team. First, we have Hervé dialing in from Zurich.
Hi, everyone.
Then we've got Aris dialing in from New York.
Good morning.
And finally, last but not least, David beaming in from Singapore.
Hi, everyone. Good evening from Singapore.
Great. Thanks, guys, for joining. So today we're going to talk about secondaries, and we're going to reflect on the roller coaster ride that we've had in the last 12 months. At the last webinar, we discussed how we've been seeing particularly attractive deal flow in GP-led secondary opportunities coming out of the pandemic. As we begin the second half of the year, it's worth taking stock. What has changed versus our original thesis about the post-COVID secondary market? What types of deals are being done? And critically, will the attractive secondary deal flow continue, or has the opportunity window already closed? My colleagues will help answer these questions, and we will use some of our own case studies to highlight the kind of opportunities that we're seeing and other market participants are seeing. In terms of timekeeping, the whole webinar should take around 30 to 40 minutes. During the webinar, should you have any questions, please don't hesitate to submit them to us in the dialog box at the right of your screen. We'll be delighted to receive them, and I will endeavor to answer as many of these, and I will ask them, in fact, to my colleagues at the appropriate time. So first, let's go to Hervé, who'll tell us about the market.
Hello, everyone. Again, let's first look at the volume of a secondary market evolution. So following a record year in 2019, volumes dropped last year for the first time really in a decade, triggered by the COVID-19 pandemic. However, the second half showed a strong rebound in volumes, more in line with what we've seen in 2019, but with a clear preference for more concentrated transactions around COVID-proof sectors like healthcare and tech-enabled sectors. What we see today is a continuation of this trend in 2021, with the current expectation that 2021 will be the biggest year ever in terms of volumes. On the one hand, you have LP transactions, so like single or portfolio of fund stakes, continue to provide deal flow, and the projected slowdown in distributions and delayed portfolio management exercises will likely act as a driver. On the other hand, there has been a surge in GP-led activity to almost double versus previous years, and now representing more than 50% of volumes in 2021. GP-led deals historically were more often tail end or legacy fund restructurings. Today, we see mostly single or multi-asset continuation funds as GPs are tapping increasingly into the secondary market to generate liquidity for the LPs, alongside the more traditional exit avenues like trade sale to another financial sponsor, or IPO. So these have given secondary players a unique opportunity to access the best performing portfolio companies from these GPs. So in summary, we expect volumes to reach all-time high in 2021 with a return of LP-led transactions, but notably by an unprecedented growth in GP-led transactions. So let's move on to the pricing. Similar to what we see on the volume, there was a temporary dip in pricing at the onset of the global pandemic in the first half of 2020. Generally, in the second half of 2020, prices rebounded across the board and across the strategies. The main price increases were on deals with exposure to COVID-proof sectors, driven by increased buyer selectiveness, as mentioned before. This is shown in the biggest jump of 15% for venture and growth funds with exposure to late-stage tech and healthcare. Going forward, we don't expect the secondary market pricing to increase much further, especially since underlying asset prices have increased materially in recent quarters. As a conclusion, market pricing may fluctuate as we've seen it. We are back to pre-COVID levels, and as always, asset selection remains the most important factor in secondary investments.
Hervé, given, as you said,
Yep.
we're up from the lows of mid last year, should investors be concerned about the ability to generate decent returns in today's secondary market?
So I would say pricing volatility is something that we feel has not impacted our return expectations or deal-making capabilities. So in our approach, we really look at intrinsic value of the underlying assets we buy by really understanding their business model, valuations, and the growth potential of these assets. We think we're able to do this given our approach, which is focused on smaller transactions with on concentrated portfolios of 1 to maximum 10 underlying portfolio companies through a detailed bottom-up analysis. So ultimately, we care much more to buying high-quality assets with growth potential at fair price rather than looking at the headline discount to NAV.
Okay, very clear. So over to you, Eris. GP-led deals have become the dominant secondary deal type, as Hervé just explained. But is this a temporary post-COVID phenomenon, or do you think it will continue?
Yeah, it's a good question, Paul. I mean, one of the key reasons for the surge in GP-led activity has been for the need for the GPs to give liquidity to their cash-starved LPs in the quarters following the onset of the pandemic. And now we're a year later where we have a situation where on the investment side, the market is red hot and there's fundraising and capital deployment, but exit activity still remains well below the activity and levels we saw pre-COVID. So this mismatch between capital calls and distributions for investors, we project will lead to a year of negative cash flows for LPs. And I think this is one of the key reasons why GPs will continue to look at the secondary market and adopt fund restructurings as an alternative to the more traditional exit routes. So when you look at broad picture, we're still in the very early stages of the adoption of the GP restructuring. And we believe the market will continue to develop and mature with more GPs taking under these exercises after they see the value that can be unlocked.
It's an interesting point you make about this liquidity squeeze on investors, but why does this necessarily lead to more GP-led deals rather than traditional LP interest sales?
Sure. I mean, the great thing about this type of transaction is it offers optionality to all investor groups. So for the GP, they're able to hold on to their best performing asset for longer, create more value, make more economics. And existing LPs have true optionality. So they can either roll or sell as part of this restructuring. And then finally, for players such as ourselves, it's basically an access story to assets where we would not be able to gain access otherwise.
Okay, very good. So all this talk of the surge in GP-led deals in the last 12 months does make it sound like a recent phenomenon. However, as we saw in the chart from Hervé, the first GP-led restructuring deals were being done in 2015-16. And as you can see from our history, GP-led deals have been a key secondary deal type for us from 2016 onwards. Since then, we've done over 50 GP-led deals. But our philosophy is that we are indifferent as to whether we access attractive portfolios through GP-led deals or traditional LP stakes. Nevertheless, in the past 3 years, the vast majority of the deals we've done were GP-led. This is because our strategy of targeting concentrated portfolios of high quality, high growth companies which play key themes nicely matches the typical characteristics of a GP-led transaction. So David, why don't you take us through some of the GP-led deal criteria that have been particularly important to us in the last few months?
Sure, Paul. So we have identified some of the key underlying criteria for GP-led deals. So specifically, we are looking for high quality companies which has proven resilient during the period of COVID. So benefiting from tailwinds like digitization, we have invested in Ivanti, which is an enterprise remote software sitting at 1.7x as of Q1 2021. Personal Wellbeing Foundation Consumer Healthcare, which is another example that we have invested in. and a cleaner environment for all of us to live in, such as Project Sunshine, which Aries will walk us through later in detail. And some key characteristics of these businesses are good visibility on the revenue, strong margin profile, and a high cash conversion rate. So in addition, what is really nice is the ability to cherry pick the best performing assets and put them in a structured vehicle, like a sidecar or an SPV, and set the terms. So later I will walk through my example in Asia, Avata Ventures, where we try to create a strong alignment of GP interests by ensuring that the GP has sufficient skin in the game. And we also create a tiered carry mechanism to provide good motivation to ensure that there is good asset performance. Is critical to the GP's future success and longevity. And then lastly, we try to stay away from competition, auction-driven process by focusing on our core expertise, which is on the small, complex secondary transactions. So this is where we understand speed and structural flexibility is key to the sellers, where price is less sensitive than liquidity.
David, we saw earlier from Hervé how pricing has been trending upwards lately. How do we ensure that we don't get carried away and start overpaying for deals?
You're absolutely right, Paul. Right now in the market, pricing is pretty stretched. I would say toppish at the moment. And we try to stay price disciplined by focusing on GPs who have historically been pricing relatively conservative in their valuations. And also our underwriting is where multiple arbitrage is not a key factor.
So overall, including the 3 deals we just spoke about, we've now closed 13 deals for our current fund. We did the first deal just over 9 months ago, and thanks to the rapid growth of the underlying companies, we can already show some very nice value appreciation across the whole portfolio. Thus, at the fund level, the overall valuation is already 1.3x as at Q1, despite the young age of the portfolio. This immediate value creation nicely demonstrates how these particular deals have enabled us to target concentrated portfolios of high quality, high growth companies. In fact, if you look across our 4 most recent secondary funds, which include all deals we have made over the last 10 years, this same pattern of value creation is evident. Our returns are being driven primarily through net asset value growth. The initial discount we paid has played a minor role, and leverage has not featured at all. We believe that this is how we can deliver consistent returns across any market environment. So, to conclude on today's webinar, the secondary market, as we saw from Hervé, is on track to have its biggest year ever, driven by GP-led deals, although LP-led are also on their way back as well. But it looks like the opportunity for GP-led deals is not going away anytime soon. Our strategy is well placed to take advantage of this current opportunity. And through our large network of small and mid-market GPs, we're now sourcing almost 700 deals per year, a notable step up from the 400 to 500 deals per year we were seeing pre-pandemic. This allows us to be hyper selective, choosing only those deals that match our strict criteria, as highlighted by David earlier. We only do 12 to 16 deals per year, which is a 2% conversion rate only. Each deal requires detailed bottom-up due diligence on each company and a deep knowledge of how to tailor transactions in order to optimize both alignment and outcomes, as laid out in the M80 example. The results in our current secondary fund, which we're raising now, this has led to a 40% deployed portfolio already marked at 1.3 times, and on track to provide investors with ultimately high returns and attractive cash flow features. So before we go, I've had a few questions which have come through during our discussion. Hervé, let me ask you the first one. We've got someone asking about the impact on interest rates, and that has two effects, I imagine. Firstly, it makes leverage even cheaper, and secondly, it keeps on pushing prices up as investors become less return sensitive.
Yeah.
So we say we're not using leverage, but are we missing a trick here, especially with it being so cheap?
Yeah, as you've talked about it before in the value creation, but as a background for everyone's benefit, we don't use any leverage on any of our secondary transactions. So we build high conviction on concentrated portfolios through a bottom-up analysis without the need for leverage to reach target return expectations of 2x MOI and 20% IR. Leverage, we see it more fit for larger diversified portfolios with limited upside, which we believe is a different than our secondary approach. So.
Okay, good. And Aris, I've got a question here. The US markets, we've been talking about sourcing, and the US market is indeed known for being more intermediated. How can we continue to source attractive deals over there?
Yeah, that's a good point, Paul. I mean, it is true that a lot of the U.S. market is in fact intermediated, but as a result of our primary relationships, we're often in situations where we're made aware of these transactions at much earlier stages. And in certain situations are even the ones who are suggesting, which advisors to choose to the GPs. So even when intermediaries are using a transaction, we choose to focus on the situations where we have an important angle and kind of a Unigestion edge. I guess a good example of this would be Project Machine, a transaction we completed late last year, where it was an intermediated spin out of a GP where we knew the team and assets for over 20 years. So this gives us a really running start on the diligence. And then in addition to kind of your more classic GP-led restructurings, through our update calls in our GP community, we're always trying to be solutions-oriented and creative in problem solving in ways for us to gain access to the GP's best performing assets, and at the same time solve some sort of issue for the GP themselves. So really, constantly brainstorming, trying to be creative, looking for differentiated deal flow.
Thank you. That's good. And then David, I've got a question here. In Asia, the GP-led market is of course more nascent. We talked about a sidecar deal we did in India. We haven't yet talked about any restructuring deals. But does this limit the number of deals that we're possibly doing in Asia?
Not really, Paul. So we are starting to see an increase in GP-led transactions, mainly due to the long tail fund positions of older vintages, as well as the delay in exit plans due to COVID. In addition, we are also seeing a handful of GP spinouts where we can also provide secondary capital to help them in a new platform, as well as some secondary LP stakes. So as we are speaking, we are doing due diligence on a pan-regional Asia buyout manager, as well as a China country-focused sector GP.
Okay, thank you. And then Hervé, a question coming in. It's about the size of deals we're doing, because as I showed in the portfolio, they all seem to be around the similar ticket size. But does that affect the size of GP-led transaction that we will do? In other words, will we only do GP-led transactions which we can lead, or will we also participate in larger GP-led transactions? Hervé, first to you, and then maybe Aris as well to you about the US.
Yeah. So as you all know, we always have a focus on lower mid-market transactions. So I think this is where we are the strongest in the market, and also the closest relationships with the GP. So in that respect, also, this is where our angle is the strongest among GPs, and we definitely look at leading more and more of these transactions in the market. If you look at the size of the companies we typically target, so it's likely some of the best assets from these portfolios. So you look at lower mid-market up to mid-market companies in this market.
Okay. And then Aris, what are your comments in the US? What kind of size transactions are we doing?
Yeah, I mean, it's true. We do focus on the lower to mid market. That being said, there's a lot of activity in other areas of the market, and we don't want to cut ourselves off from that. But there has to be a unique angle for us to kind of double down and pay attention to the situations. Whether that's somewhere where we have information asymmetry or something like access, it has to be kind of something out of the ordinary and really special for us to kind of move out of the lower to mid market.
Mm-hmm.
Okay, that makes sense. So if I summarize, we like to lead, we like to co-lead, but we will also participate in larger transactions if we see there is a clear angle for us. Great. Okay, thanks. I think that's the end of all the questions. Now, look, if anyone has any other questions that they haven't asked yet, then please don't hesitate to contact us. We have the contact details here, or you can email directly any one of us, or including your relationship managers. Thanks for joining us. Thanks for spending time with us today. We hope you enjoy the rest of the summer. In the meantime, we look forward to having you at our next webinar. Thank you. Goodbye and good luck.